All right, good evening, everyone. So today we want to look at a trading system, which is the MT4. There is also MT5, but MT4 is more friendly to use. So today, for the purpose of this video, I decided to put in $60 so that we can use it to jangle around. So I'm sure those of you that are already trading, you know how to log in and all those things. But the parts that I want people to understand when it comes to trading is when you pick a pair and the timing at which you enter the market and the few things that you need to look at. And so we'll be looking at things on the market watch. So when you come to market watch, the first thing you want to do is to right click and just open up the pairs, and then you can right click again and select spread. Your success and failure in your losses and your gains are mostly dependent on the spread that you use. So when you take spread, you will see this I sign here, this exclamation sign. Okay, let me just extend this. Okay, so this spread is the difference between the ask and then the bid, plus what the broker is charging you for giving you this platform to work on. So mostly we don't come back to look at what spread we trading with, or at what spread we are entering the market with. So we may enter a very high spread, and so we don't realize profits early. For example, if you look at the spreads here, you find out that the Euro USD is 16, which is low and it's normal. You will see gold is, fluctuates though, 30, 32, 34 there, which is normal for gold because gold is a mineral. And then so when you look at the other one, you'll see 20 and all that. Now, if you look at the Hong Kong, the USD versus the Hong Kong dollar, you'll find out that it's 260, which is pretty high. So when you're trading accounts less than $10,000, you don't even want to place a trade having this spread. These are the first things that you want to look at. You take this the Polish scrutiny, it's also high. So USD ZAR, you'll find out that it's very expensive. It's 870 up there. Once you see the spread this high, it means that the currency pair is exotic. It's exotic in the sense that you need a huge capital to be able to trade it. So a pair like this, with this kind of account, if a trend goes against you, it wouldn't take time to wipe the account off. So the first thing that you want to have an understanding is the spread. And if you go down, you look at all the instruments, each has what it offers. So you look at the Turkish lira. The lira is a very expensive currency. That's 2,000. The spread is 2,000. So if we should even place a trade on this account, it will tell us that no money. If it accepts it, it means that your margin will drop. What it means that the loan given you will go down. So the first thing you want to do is that you trade pairs that are having lower spread from 30 down. So if maybe you go down, 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 you will see even the shares, some have zero. Okay, these are equities. All these equities, you find out that they have low, low, low. Amazon is it's a bit expensive, 100 and something. It can change. Amazon can go up to 3,000, depending on what's going on. So like example, penny stocks, you can find them zero. They trade below 5 on the spread. So they are cheap. But what happens is that you have to leave them for a long time. That is why I personally prefer to trade currencies, because they are more volatile and more predictable. So the first thing you want to pay attention to is the spread. That is the first thing that you want to pay attention to when it comes to understanding the system. Then we come to the new order. So this is Euro USD. Do I have a trade on it? So let's say I want to place a trade on Euro USD. In as much as I've looked at the spread here, and the spread is 17, I still have to make sure that the points at which I am entering the market is not high. So the points are the last, this figure and this. These are the last ones. So you just subtract this from this, and then you'll find out whether the market is oversold or overbought. You can use indicators, but indicators are really not going to show you the volume that is being traded to make the pair to be oversold or overbought. So the best way to find out whether the pair is really oversold or overbought is to look at the difference between this last figure and then this last figure. If it's 3 and below, then you are good to go. If it's not, once you want to place the trade, you wait. It fluctuates. Like now, it's just 1, which means it's very, very, very low. So when you enter the trade, it won't take that long time for you to realize the profit. So you want to pay attention to here. Mostly when we place trades, we don't even pay attention to this thing, but it is part of the system. If you want to get in with a good rate so that you utilize this margin, you want to utilize this margin well, then you have to pay attention to at what price you enter the market, and then the spread at which you are trading on is very, very important. The spread, and then the digit at which you are entering the market is it's a quote. It's a quote, and so you want to pay attention. If it's more than 3, you wait. It fluctuates. It will take maybe some minutes or seconds, and then it will come back. If your internet is slow, you won't see it well. And that's why when you're trading, you want to have a better internet connection. Once this is taken care of, and then you select a lower spread, you'll find out that when you place trades and then it runs into losses, it can stay there or go against you for a longer period, and you still maintain margin. So these two things are very important for every trader. Then the next thing is setting up the parameters of the of your chart. This chart is your working space, and then this trend is your friend. If the charts are not well set, it will be giving you kind of a fake representation. So when you follow it, later before you realize that you probably did a wrong analysis on the chart, it's because you haven't set the parameters well. There are trading systems, I mean the computers that are strictly trading. Now, we are not using those systems. We are using any computer at all. The trading computers are set in a way that the resolution is clearly set. So the charts don't have imbalances. So this is how you set it. You just zoom all out. Just clear this. When you zoom all out, and then you reduce it, you zoom all in, and then you zoom out just once. Once you do this, then you now have a good parameters to work with. So if you look down here, this is 4 hours, you'll find out that this is 3rd June. Yeah, 2021 to today's date, 22nd. So you'll find out that you're having, how do you call it, a good parameter to do your analysis. So you can shift them in the middle, or you can just shift so that it goes up. It's best to look at it this way so that you will be able to kind of have a space here to help you as to where the price is going in the future if you are just using a clear chart as this. So that is another thing that you want to look at. The next thing is where you find the things that are on the, and just remove these things. Okay, so you find out that we don't have anything except the chart. So to put them on, you go to view. Anything on this chart, you can find them on view. This system is just like how to use it. MS Word. Everything that you need, it's here. So let's take the terminal and then we'll take a look. Now, the next thing we want to look at here is exposure. That is when you finish placing your trades. When you have trades on, you want to always come to check your exposure to see which currency dominates the others, and check. So if we come here, we'll find out that we have the assets that I'm trading. You'll find out that here the assets are not in pair unless it's a mineral or exotic kind of a pair. Okay, like we have gold here. So what it means is that though a dollar is backing gold, it's not trading as though they are pairing. The gold is trading as an individual asset. And so you will always see it under the assets pairing, but it's alone. So you'll see shelf is alone, euro is alone, JPY is a loan, and the USD is a loan. Then among all of them, the one that is most is the USD. So what it means is that the USD carries the greater risk here. I have exposed the US dollar so much on these. Therefore, my risk exposure is on dollar. So if I want to place next trade, for me not to expose my account more to dollar, then I need to look for a pair that has nothing to do with dollar. So maybe I could go for, let's see, maybe Euro JPY, AUD CAD, AUD New Zealand dollar, but not Euro GBP. Euro GBP has a positive and negative direct inverse with the dollar. So if I take a trade on the Euro GBP, then I will be exposing myself more into risk. So let me just show this. If you look at the Euro GBP, it's selling. Automatically, the GBP USD is buying. So let's just look at that. So you see, if you look at the GBP USD, it's buying. So anytime GBP USD is buying, Euro GBP will be selling. If it's selling, if it's buying, if Euro GBP is buying, then GBP USD is will be selling. They always move in that proportion. What it means is that in as much as dollar is not showing here, dollar is still influencing the movement of Euro GBP just as it does with Euro GBP. And so in terms of exposure to how much leverage you are using, you want to avoid running Euro GBP with USD pairs at the same time when you are trading smaller accounts. I believe most of us are trading smaller accounts or growing smaller accounts. So that is that side of exposure. So always you want to come to check, okay, which pair am I more vulnerable to? That is the USD. So let's go back and see why. So if you look at it, I have gold versus USD, and then I have Euro versus USD, and then I have SHEP versus JPY. So the USD here is quoting, and the USD here is quoting. When one pair or when one particular currency is quoting, you increase your risk. So mostly you want to make sure that when a pair or when a currency is quoting, you don't actually repeat that pair. You want to look for a different pair. So here we have gold USD. Then I wasn't supposed to bring the Euro USD because it's going to increase the exposure on the dollar more. So probably I could just pick, say, maybe CAD JPY. I'll still be doing the same thing because there's a JPY there. So maybe GBP AUD. Then I've balanced the risk here. So I've managed the exposure, but mostly we retail traders, when we trade it, we don't pay attention to some of these things. And that is why we end up running higher losses than we should, or we run our margin into more, we run them lower, or we eat into the loan given us from the margin. Now, if you look at the balance here, this is the deposit that made. If you look at the time, just for this training, if you look at the time, I think this is 6:31. It's 7 something. So $60, and then I started to trade, to place bets on this account. So when you have the account, you won't see this margin, you won't see this free margin, and then you will not see this margin. You will only see balance, which will be $60, and then you will see equity also, which will be $60. Immediately you place the first trade, then the margin will pop up, the free margin will pop up, and then the margin level will pop up. This margin is equal to how much capital you deposited. So when you place your first trade, it reduces that margin. Then initially it will be $60, but immediately you place the trade, it will give you the equivalent of the margin on the trade that you have placed. Now you then have the free margin. So this percentage is this free margin. This is the percentage that is used. The percentage used of this free margin is this margin level. The broker will allow you, so this is the loan actually. So this free margin is the loan that the broker has given you. I am using 1:3, a ratio of 1:3. That is 300. So when I place my first trade, then it will show. It's a mystery how some of these calculations are, so you don't want to bother about it. But you constantly want to pay attention to this margin level. Right now, I'm having a margin level of around 300, so it's safe. But when it runs to 100, when this goes to 100 and below, the broker or the system, this system is set, it will automatically notify me that I have overused the free margin or the leverage or the loan that I am given, and therefore I am demanded to add money to the account. If I don't add the money and then it runs down to 30, some brokers will allow you to like even below 30, then they will close the bigger loss. So the bigger loss is what they will close. If it still hasn't taken the account from a margin call, it will close another one. Now, because it's automatic, the system may close probably most of your trades. So you don't want to have that margin call. Once you have that, then the account is going to be blown off. The account being blown off means that you have no money to trade with. So you want to pay attention to this so that you will always have what? Money. So basically, that is how you manage your exposure. So you hear somebody will ask you, how do you manage your exposure? It's just asking you how do you balance the pairs that you trade? How do you balance them? Now, if you look at the volume, you'll find out that these are the volumes being traded in Forex. When you go to new order, this is a volume. What it means is that the amount of money that you are investing, these are in units. So if you want to know the figure, you multiply by 10, then it will give you the dollar figure. So this volume is what we see here. That's what we see here. So you'll find out that the chef on 2,000 units, on Euro, I'm on 1,000 units, on JPY, I'm on negative 241,122. Then the USD, because it's the one quoting, you'll see that it's fluctuating. It's fluctuating because it's quoting. And if you look at the dollar too, because dollar is a mineral, it's standing on its own. You will see that it's -1 here, but you see its other indexes, like the rate is changing. And this is the dollar unit that you are trading at. So this is where the problem is. Now, how much actually am I trading on when I look at chef? That is how much. I'm trading chef $7.26. So let's go to see. This is chef. I have a 0.02, which is 2 cents. And this chef alone, the exposure I have there is $7.26 pesos. But now, if you look at this trade, it's not even close to that $7. So I'm going to cover that amount. This $7. I'm going to cover this amount before I will see a profit. So when I see a profit here, it means that I have actually made money or realized profit beyond whatever I see here, which is here. Because until I cover this, I am not going to see profit here. So now the trend is still against me. It has to go above this entry point so that I will realize profit. If you don't understand this, especially here, you will think that, oh, I just invested 2 cents. And therefore, you know, I can just work it around just like that. But it doesn't work that way. This is expensive. So what I need to cover to see profit here, it's here. It's $7.26. And this one is on chef. If I come to euro, my exposure to dollar here is $3.98 pesos. And this is euro. I have euro USD. Now you see, it's a base. Now, if we come to the USD, the total of USD that I'm exposed to is 35 point something dollars, still fluctuating. So dollar is king. It doesn't matter which market you are trading in, stocks, commodities, whatever, you need dollar. If you don't have dollar, you won't be able to transact businesses. So recently, you find out last week, China and Russia have decided that they will make exchanges between them using their own currencies, which will not work. It's only a matter of time they will find out that it's not profitable. So basically, when you are trading, you want to make sure that how you manipulate the dollar is well crafted. So if you look at JPY, it's in negative. Now, why is it in negative? You see the volume is in negative, and therefore the dollar value is also negative. But this is what you still have to pay. So this is the double effect, or a double kind of a tax, because you have to get this out of what? This negative. Now, when it comes to gold, you'll find out that the volume of gold is just -1. But look at its rate and look at how much gold is here. This is huge. So you find out that I have gold 1 cent here. 1 cent. But this can wipe out this account in a minute if it should go against. But I checked a lot of things before placing the trade. So I wanted to see whether the account is on a good page of the broker or not. And so I placed gold so I could see if it was going to take the margin down to the 0. But it didn't do that, so I know that the account is on what? A good page. So this exposure is what you have to pay attention to. Now, when you're trading and then trades are against you, you want to reduce the pairs that are being quoted by the dollar. Then you see that this will become more smaller. As we move on, we'll come to understand the exposure better, but that is just a bit about the exposure side. So when you are placing trades, you want to make sure that when you place Euro USD, you don't go and take Euro JPY, Euro whatever. You want to make sure that you mix the pairs, your assets. So if you see here, these are all assets. These are all assets. You want to mix them. Once you are able to mix them, say, I have gold here, there's USD. So then I don't need to place another trade that is having what? A USD. So I can just keep this guy, and maybe look for maybe AUD, New Zealand dollar. It has no inverse or no relationship with the dollar. Then I will be safe. But once I have this and this account right now is being overtraded. I'm overtrading this account because of the gold that I have here. The value of gold is expensive. Now, this is how you calculate. So the next thing is when you are entering a trade, you have to calculate the price of the trade. For example, this is, let's do for Euro USD. This is Euro USD. So this is the current price, 1.1943 something. So the price is calculated by 1, which means the lot size times, that is 100,000, times the price, which is 1.19, say 443. It fluctuates, so the one you picked last is what you can use. So you have this. So I'm using a leverage of 300. So you should know the leverage that you're using. So I divide this by 300. So the price of Euro, USD, if I were to be trading one lot, is 398.14 cents dollars. That is high. So when you are placing a trade, now you know that this is the price that this pair is selling at the moment. So you find out that I've placed $1, but this is so expensive. This is high, but that is the minimum that I could place. So you want to make sure that you check, and if it's so high, you don't even enter. Let's try gold. We have 1 times 100,000, which is the same as 100,000 times gold price. Let me just drop gold there. So gold price is 1,775 point. Let me just leave it like that. So we have this divided by my leverage is 300. So the price of gold, it's 591,666. Yeah. So you find out that gold is so expensive. So once you see this, you stay away from it. So it means that you need at least $100,000 or $50,000 to even be messing around with what? With gold. So what I have here, it means that I've actually exposed this account to the highest risk. So you want to know how much a pair is worth even before you place the trade. So if you take ZAR, and you calculate ZAR, let me just shift this guy. So let's check the price for ZAR. So it's it's 1 times 100,000 times the price of ZAR, which is 14.24, say 586. I'm using 300. So you have to know how much leverage you are using. So the ZAR, the price of the ZAR is 4,748. So that is expensive. So you don't want to trade it. You want to trade those that are like in hundreds and tens. Now let's do the last one, say GBP JPY. So let's check the price for GBP JPY. So remember, we are looking at the things that we're supposed to look at before placing one trade. And the main reason why many retail traders don't make money is because they don't know about these things, so they don't pay attention to them. So divided by my leverage 300. So you find out that GBP USD, it's 465 the price. So I can trade it, and it's not going to give me much problem like those ones that are in 1,000. So before you place a trade, based on how this system is built, you want to understand the spread. You want to check the spread and make sure you don't go for a high spread. So during market volatility, these spreads will be so high. So you don't want to take a spread that is high. It means that you will be exposing your account too much. It means you will be over leveraging your account. So you don't want to overtrade the account as well. You check the spread. You check the spread by clicking on the market watch. You look for spread. When you click it, it comes this way and you see it here. If you are using your phone, You just right click on the side there on the stock, and then you add spread. Then it will show you how much spread that is being charged at that time. So here, don't use high spread, use spreads that are below 30 and below, fine. Yeah, even a bit over 30 is okay. Secondly, check the price of the pair that you want to trade. And how do you calculate or find out the price of the pair? I said you do that is 1. The formula is 1 times 100,000 times the price, and you always see the running price here, times the price divided by your leverage. Someone may be using 1:100, so you will divide that figure by 100. 1:500, so you will divide that by 500. That is how you calculate. If the price is too high, you are trading a small account and the price is in thousands, even if it's, I think, 500 and above, that is high. You want to avoid that pair. Look for a pair that has a cheaper price. Then thirdly, when you come to place the trade, you want to make sure that, see, this is a hidden price. You don't see it, it's hidden. So all you need to do is you leave all this and check the last 2 or the last digits. Okay, so somewhere like this, you have to check the 2 because this is 48 and this is 51. So what it means is that the difference here is 3, which is good. So you can still place the trade and you will get a cheaper price. So when it's above 3, you wait till it reduces. The difference between here and here, make sure it is 3 and below. You can even get 0. Now, when you check this thing and then you place the trade, then you will not run down your margin. What it means is that you are trading professionally, you are managing your margin or the borrowed money that the broker has given you well. Now, these are the things that you need to check to place trade. And these are the things that when you understand them, then it means that you understand the system. These are the hidden things that you need to know. Under normal circumstance, this is too small money to be traded. But you see, you can write this account number down. You see, this is live account. You can write it down. Maybe I think when Thursday or next week, I'll still bring up this account. And it's possible that this money can go to maybe $80, $100, even $200. It's possible. What it means is that the broker has given a leverage, a borrowed money, to enable me trade more than this deposited amount. And that is the margin, this free margin. So I put $60, but that $60 is like I'm trading like I have $600 account, because this is a standard account. So it's running in tens, in 100,000 of units. Otherwise, I couldn't have placed 2 or 3 trades. But see, even I have Chef JPY 0.02. So in total, what I have under my portfolio right now is 4 cents. I have 1, I have 2, and then I have another 1. So if you look at them, you will see that I am actually over leveraging the account, right? But I know what I'm doing. I know what I'm doing. So, but you don't do this. If you trade in account like this, you want to place only one trade at a time. One trade at a time. Only one trade at a time. Don't do what I am doing. Okay. So basically, these are the things that you need to understand when it comes to understanding the trading platform. We talked about the spread. Don't use high spread. Choose those that are low. And then secondly, check the price. How do you check the price? We say the formula is 1 times 100 times the price. That is how you check it. Then you check the hidden price. There is always a hidden price. And that hidden price, you check it by looking at the, how do we call it? Looking at the last digits, which is this. You know, mostly you'll find these and these, they are the same. So you want to look at the ones that are behind the, how do we call it? The decimal points, which is these points is the points that moves to form the pip. You don't want to look at that now, but you want to pay attention that the difference between here and here is 3 and below. If it's more than 3, then you are going to be paying for a hidden spread. You'll be paying more than you are supposed to be paying. So if the broker wants to lock you in, when he locks you in, it doesn't matter what you do, that trade is not going to give you profit. It can be there, you're not going to see any profit. You might see the profit come, just small, and it goes, and it never returns. It's because the price is so high that even if it moves in your favor, you are not able to realize profit. So you want to take charge of that. These are the things that retail traders don't look at. If you trade in the as a prime or as an institutional prime, some they don't have these spread issues. They have a fixed kind of a charge. So, but if you trade for banks or insurance companies, hedge funds, yeah, what happens is that all these calculations are done by the analyst, and so they just give you the cheat, and then all you do is to place the trade. Then it's easier that way. But when you're trading as an individual trader, you actually want to calculate these things. To be frank, I don't even do these things anymore. What I check is that I check whether there is a hidden price or not. I check here, I check once the difference between here and here is 3 and below, I can place the trade. But you want to understand that there are these things in the system. These are the most hidden things from traders, especially if you are trading a smaller account, $50, $100 to say $5,000, even $10,000 account, it is what? Small. I'll show you an example on a demo. So this account was a $5,000 account. And so what I did to check this hot FX guy is to chop the account down, chop it down to $70, and then regrow the account back. So I think probably maybe it took 2 months. It took 2 months to grow the account from that $70 back to where it is right now. And that is what I'm trying to replicate with this account, to see if I'll still be able to use the strategy that I was using there to grow this account from now to, say, maybe October, thereabout, if I can grow it to 5,000, and trying to observe all these little things when placing the trades. So I think I'll allow for questions and then we can close. So, okay, let me leave the video on as well. So you can unmute if you have a question, and then you can just ask your question. So, yeah, anybody with a question, if you have a question that you want to ask, probably you're trading, there are some inconsistencies that you are finding, you want to ask about the things that I just talked about.
Yeah, hello, good evening.
Hello, good evening.
Yeah, thank you for this class. First, let me apologize. I came in a bit late, and then also the network issues here in Lagos, Nigeria. But I still got some things. So I want to ask, how do I identify where, or how do I identify my leverage? You know, I heard you say your own leverage is 300.
Yes.
Is this something I calculate? Is there somewhere I check to know what leverage I'm using?
Yes, so you log in into your account. Okay, I can't show you this. You log in into your account. When you log in into your account, you will see you will see it there. Let me see, probably maybe. What is this? Okay, this is the zone stuff. So you log in into your account. When you log in into your account, you will see there, right? If you log in, you just log in into your account, and then you look for the leverage. You will see the leverage there. You can ask your broker, and your broker can direct you to see the leverage that that you have. Okay.
Okay.
Some brokers, when you open the account, they select the leverage for you, like Capital Index. Some other brokers, they select the how do you call it, the leverage for you. Those are A-book brokers, so they don't allow you to select the leverage because they may not have the liquidity to that level to borrow you. So they can just give you maybe 1:100 or 1:200. So anytime, but you will see it at the back of it, or you can ask them, they will tell you. But mostly, you select your own leverage. Yeah, which is like from 1:50 to 1:1000. And I will advise that when you opening accounts, don't use high leverage. Use from 400, 300, 200. These are okay. They will still make you make a lot of money over time. From 800 and 1,000, and you will definitely overtrade the account. Even if it's just one trade you are placing at a time, maybe even just 2 trades. I hope you are clear.
Yeah. I'll find out to get the leverage to find out. Yeah.
All right. Awesome. Okay. Any other question? If there's something you don't understand, you ask. It's being recorded. We'll see how to send it through. But if there's something you don't understand, you can ask. Or if you are late and there's some way that you want to understand, you can actually ask. We're here to answer you.
Okay, I think there's a question on the chat box.
Oh, okay.
Where, okay, it said, how did you calculate? Let me read
How you calculated
it up.
the price of the trade? Yes.
Can you show how you calculated the price? Yeah.
Okay, so this is how you calculate the price of any pair or any instrument. The formula is 1 times 100,000. What it means is that if you come here, the standard lot size is 1, that is $10. This one is $10. This one you see here, which is $10, is actually 100,000 units. When you place one like this, you have placed 100,000 units. Now, if you look at my, I don't know. How if I close this, I'm not going to close it the same. Okay. So if you look at my exposure here, you see the shelf that I place here is 2,000 units. That's 2,000 units. Yet you'll find out that this shelf trade is only 2 cents. So it is 1 times 100,000 times the price. So let me just this my, I don't know what I did. Okay. So times this, so this is shelf, so times this price. You use the current price. So it's 1 times 100,000 times the current price. So here I'll use 120.524. So 120.524 divided by your leverage. I am using 300. So you'll find out that this is 40,174. Now, the higher it is, the higher is going to give you profits or losses when it goes against you. I hope I've answered you. Are you clear as to how to calculate calculate the price? The formula is 1 times 100,000 times the current price divided by your leverage, and you know how much that price, how much that pair or instrument is worth at a particular time.
Sorry. Now, based on what you just said now, by the time you get the price, it means that, of course, if it's going in your favor, that's how That's what determines what you get, and then if it goes against you, that is what determines what you lose.
Exactly. That is why if I'm trading, we are trading, and I calculate the pips, right? If I calculate, if I tell you that
that price.
Okay,
That price.
So if I tell you that this, say this, I'm running maybe, let me use the crosshair. So this is, okay. So let me put here. So this is like 96, 90, 87. So let's say 87, 90 points, right? I will use points, not pips. You see the one in the middle, you see 87 there. I will say points, not pips, because I am not trading in one. This is one. This is one. I'm trading in cents. So once you are trading in cents, the movement here, the system will calculate it for you in points, not in pips. But if you are using one, then one point movement is what? A pip. So for me, I don't even care about calculating pip or knowing how much pip and all those things. Yeah, it's good to know them, and it helps you to know how much market has moved. Instead, this is what I do. I use these boxes. I use these boxes to identify the pips and the point, because each box has a volume based on the time frame that you're using it. Right now, which is in 4 hours. So this is 297. You divide by 10, you will get the number of pips. If we come to 1 hour, same box is going to give a different figures. You see, here is 93. If we go higher, it's going to give a different one. So depending on which time frame you are and the pip or the points that you are going to get. You trading small money, you don't want to waste your time on those things. What you want to pay attention to is make sure you calculate the price, use the formula 1 times 100 times the current price divided by your leverage to know whether the price is too high or too low. That is one. Check the spread. Don't go and place a trade of this 261. That is too high. Don't do that. You will kill or reduce your margin, right? The more you reduce your margin, the subsequent trades you place will not easily get into profit. That is the idea. When you have lower leverage, it is going to be difficult for you to get into profit. For example, this is a big account. So I come here. I can decide to place trades on any pair, right? But this is demo. So the spreads are given without the additional ones, like commissions and all those things are not added when you are trading demo. But the normal spread of the market is what you see. Now, let's place a trade here on, this is 26 GBP JPY. So where is it going? Let's see. It's going up. So let's buy 1. So we buy, right? So you see that the buy, it starts the losses in $27. Now let's take a higher one, say 600. This Norwegian krone. It's selling. same one lot, and I want you to pay attention to the negative that it will bring. You see, it goes straight to 76. This is that this one is higher, right? The spread is higher, so it pushes it to be up. The normal is 30 below. And that is why you don't want to place a trade when you see the spread here too high. All right, any other question? Any other question? Can you hear me?
Yes.
No, I understand.
Good, good.
Yeah.
Okay, one last question, please.
That's fine.
Okay. Is it possible to get this recording?
Yes, it's been recorded.
Okay. Will the video be posted on the training group?
Yes, it will be posted.
Okay, thank you. God bless.
You're welcome. You're welcome. Okay. So, any other question? So, you see, how do you call it? Any other question first?
Okay, no, I think there's none.
Okay. So
There's none.
basically, as a retail trader now, I want a situation where maybe every day, whilst I trade this account, I want to make it public so that I think people trading smaller accounts can just follow. But I don't know. I don't know which software probably that I can use that can just record when I'm placing trades and then when I'm getting out of trades. This is a small account. So what I do is that this is 1 cent. So I know it in my brains that 1 cent, when it gives me a profit of $1, that is good money or cent. So if you check the profits that I picked, that is 0.34, 0.44. That is 0.78. So if you look at the time, that is the time, that's like within maybe 2 hours to make 0.78 cents on a $60 account. That is a lot. So if I see small profit and I appreciate it, I'll take it. But the point at which I'll take profit is $1 when I place 0.01, 0.02, $2. If the profit is reversing, because I will not allow my profit to reverse to a loss, I will take it and wait and replace the trade. This is historical. The price is going to come below here. So I give it a take profit of $15. So it doesn't matter. It can give me a loss of $20. I won't take it. So I've preset it. So when you're trading smaller accounts, you have one main account that is going to give you maybe your daily profit, because I want to make $20 a day on this account. So if by tomorrow morning, if this gives me $15, I look for $5, I'm done. So if I replicate that for the week, I make $100, So if I don't meet it, there's no problem. I carry on. So this and this are for scalping. So this is my main trade, and this one's any small profit that comes, I'll take them. So you want to follow just a system gradually, and then it will grow, right? Yeah, so you can trade this account to